Hello and welcome along to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And today on the show, we're talking cities versus small towns and the regions, which gets better capital growth. And this actually comes from a listener of the show, Johnny, who said, guys, you talk a lot about the main centres and the capital growth achieved there. What do you have to say to someone like Graham Fowler, who's a very, very well-known, very respected property investor here in New Zealand? So he'll often post on social media saying that over the long term, the regions, so the smaller ones, your Hawke's Bays, your Taranakis, have similar growth to the main centres. Is this data abuse or what's going on?
I love that Johnny's used the term data abuse. That made me smile.
It made me smile as well, actually, Johnny. And what I want to say is, no, this is not data abuse at all. In fact, when you look at some of the regions right now, some of them have actually had better growth, better capital growth over the long term than Auckland. So this isn't data abuse, but we can read into it a little bit more, which is what we're going to talk about on the show. But what I want to say, first of all, Johnny, is that if we're said in the past that the main centres achieve better capital growth, I need to rephrase that and say more consistent capital growth, which is what we're going to get into. Over the long term, certainly at the regional level, there is not that much difference between each of the regions. Now, there is some more variation once you get into suburb-based levels. So, for instance, we know that St Mary's Bay, which is a very central Auckland suburb, has gone up by about 9% per year. Ponsonby, last time I looked at the numbers, 8.81%. So, certainly in terms of some suburbs, you could get astronomical capital growth. But certainly at the regional level, it can be very, very similar. You know, let's just go through some of these numbers. So since January 1992, when the Real Estate Institute of New Zealand started releasing data up until just last month, so October 2020, which is the latest data we have, Otago has increased in value 8 times. So the current median house price in Otago is 8 times what it was back in 1992. That's the top region.
Yeah, and just to clarify on that, so the value 28 years ago, was it 28 years ago? 28 years ago, it's now 8 times what that was. It hasn't doubled in value 8 times.
No. It's doubled in value 3 times. So there was the first doubling, and then it doubled again, so that's 4 times. Then it doubled again, that's 3 times. But that's an annualised growth rate of about 7.48%. Auckland, which was the second fastest appreciating region, was 7.19%. So slightly slower than that. That's followed by Gisborne. And then all the way down the bottom, you've got the West Coast, which appreciated at only 4.51%. So the capital growth rates around all of the different regions are relatively similar. And you'll see this as well in some of Tony Alexander's writings. He'll often talk about this. So there's this perception that Auckland increases at the fastest rate over the long term. It's a little bit yes and no, depending on the time frame, of course, because what's interesting, and just before I hand it over to you, is that we often talk about on the show, and I remember at our live events we talked, Andrew, about how regions are at different points in their property cycles. And Auckland at the moment, we're expecting it to go through a boom phase. We're expecting some of the regions to start slowing down because they're at the end of their property cycles. So the top 4 regions in terms of capital growth, when we look at that period between 1992 and 2020, Otago, Gisborne, Hawke's Bay are in the top 4, so is Auckland. But Otago, Gisborne, Hawke's Bay are at the end of their property cycles, whereas Auckland's expected to go through more of a boom phase.
Yeah, and actually just one thing that I wanted to point out is Auckland, whilst it is similar growth to Otago, you are often talking about a higher entry level, and so the numbers get a bit skewed because you buy $1 million house today, in 7 years time or 10 years time it could be worth $2 million, so you walk away with $1 million, and so that's where maybe there is that perception, and I guess that is why probably it's one of my chosen areas to invest in, because you do come out with a serious amount of money at the end, whereas you might buy property in Otago for a few $100,000 in some instances.
Well, similarly, people will often talk about Southland. So let's just say that Southland got the same growth as Auckland, right? But if you're going to invest in $1 million worth of assets in Southland, you've got to buy 3 houses. Yeah. Now, it's not going to be as easy to get the lending for 3 different houses in Southland as it would be to get the lending for 1 house in Auckland.
Yes, and you only have to worry about 1 tenancy.
That's correct. So people are probably wondering, why are you keener on bigger cities than Ed and Andrew? That's probably implicit within this question. If they get similar capital growth over a long period, the the 28 years worth of data that we've pulled out, why are you keen on it? And I suppose the first one that I often talk about, and you'll often remember, I always love to talk about my hometown in Taranaki of Hawera, which doesn't have what I like to invest in, which is a stable and diversified economy. An economy where people have jobs in lots of different industries, so that if one industry dies or goes through a rough patch, like we've seen in Queenstown, that there are still going to be jobs there. There are still going to be tenants there. There's still going to be population wanting to live and work there that are able to support both higher house prices but higher rents as well, and the ability to pay that rent.
And actually, you know, when we see now in hindsight with Queenstown, how Ed and Andrew probably said for a long time that it was a place that you could make money out of. Absolutely, you could invest there, but there were risks attached to that investment, and that was that, you know, they had a huge reliance on tourism, and now of course it is suffering as a result of that. Yes, it is recovering a lot faster than kind of we would have maybe predicted, but one-trick ponies, two-trick ponies are at risk, and I often refer back to Tauranga when they had their crop diseases. I think it was 15 years ago. I need to actually look it up now because it's 15 years ago for the last 5 years that I keep saying that because I don't feel like I'm getting any older. And what happened there was Tauranga has a huge reliance on the port to employ people and fruit. And so you get a lot of these seasonal workers that come in, they rent a property and they work in some of the orchards or something like that, and there was this crop disease which then killed off a huge amount of fruit. As a result, the market was flat for a very long time. Now, as a long-term investor, I'd say, oh, well, that's fine. I'll just hold on to that property until the market recovers. If you don't have a tenant, that's a real problem. Or if you have a tenant at 50% of the original rent, you have a real problem. And so, you know, for me, the Bay of Plenty now being kind of at the end of its cycle, still having a certain amount of that reliance, and the fact that, you know, the kind of the upward pressure on prices is actually driven from people retiring from Auckland and moving there and taking their cash from their Parnell house and buying a $1 million house and still having a couple of $1 million in the bank. I just kind of think it's a bit of a false economy.
The other thing I want to talk about, which we haven't talked about for a little while, is deferred capital maintenance. Now, we talked about this probably in like episode 120 or something like this. But what we talk about, or what we mean by deferred capital maintenance, is that if you are a long-term investor, eventually you might have to replace the roof, or you might have to replace some carpets or something within a house. Now, if you're replacing carpets in a place in Auckland, that might cost you 5 or 10 grand, whatever it happens to be for that particular place. If you're replacing carpets in 3 houses in Southland, because that's $1 million worth of investable assets, it's still, you know, 5,000 times 3. Yes. It might be a bit cheaper because in Auckland you've got slightly higher tradie prices, but you're still replacing carpet on 3 properties. Or if you've got to replace a roof, you've got to replace 3 roofs to maintain that $1 million worth of assets versus the same amount in Auckland. And so while those yields can look really attractive in small towns, once you start having to replace the capital works on the building, that's where the costs can start to add up and eat into those long-term profits. And so your house in Southland might have gone up by 60K over a period, and you add that up across the 3 houses, that's great, that's 180K. But when you have to make those capital outlays across 3 houses, that's where it starts to become less attractive, and you're not getting the same amount of total profit out of that. Next thing I want to talk about is the stability of markets. And this is a really big one for investors, long-term investors, both because you're going to want to be able to recycle some of that equity out, but also you do want to see your long-term asset increasing in value because that makes you feel like you're making a good decision.
Yes, and actually this is something that is really interesting working with investors over a number of years. And so seeing the cycles, when a market is flat, even long-term investors that have seen the growth sometimes get it in their head that actually maybe I should just sell that property because it hasn't gone up in value in a couple of years. And certainly Canterbury, because it has been relatively flat, I have had investors who have been putting in, you know, 50, even if it's $50 a week, ring me and say, hey, is this a bad investment? Should I get out of it? And actually, particularly, you know, right now or in the last 6 months, when the market has started to show signs it's really about to take off, if I get those phone calls, I say, hey, look, if you're going to sell that property, I'll buy it, and then you will really kick yourself in 3 years' time when you see this upward trend. Now, again, if you buy something and it's going to be, in the West Coast, which may end up getting some value increase over time, but you don't see it for 20 years, then that might not be the right investment for you. But obviously, how quickly something will recover from a downturn is probably quite important. And Canterbury is probably that little bit of an exception because of those earthquakes and that kind of disjointed market for a number of years.
Well, let's talk about that. So we said before that Gisborne was the third fastest appreciating region over the last 28 years, total growth per year of 7.09%. But what's important to remember is that the regional boom only really happened in New Zealand in 2016 onwards, some a little bit earlier, some a little bit after that, and that was once LVRs were imposed on Auckland. So let's talk about Gisborne, because that market peaked in July 2007 with a median house price of $300,000. It did not fully start to recover and go beyond that until January 2018. And that was when it was about 26 to 27% undervalued through that usual model that we use to see where property markets are at. And that was in April 2016. So Gisborne house prices, median Gisborne house price, has risen 295K over the last 2.85 years. So an astronomical growth. If that didn't happen, we'd be sitting here thinking that Gisborne was a very slowly appreciating region, and wouldn't be thinking it's a good, and wouldn't be thinking that it stacks up against some of the other regions. So it's great that you've had almost $300,000 worth of growth in the last 3 years, but it was a painful 12 years if you were a buy and hold investor waiting for that growth to start, because you had to wait 12 years before it all came. Whereas some of the stronger regions, your Aucklands and your Canterburys, start to recover much more quickly. And so I went through the data and have pulled it all out for you. What I've got here for each region is when it peaked in 07-08 and then how long it took to fully recover. And what I mean by that is if Auckland peaked, as it did, at $465,000, when was the last time that it was at that price or below? So when was the last time we saw $465,000 or slightly below before the market took off again? And what we can see here, there's a very interesting thing when we compare New Zealand to the rest of the regions, but we'll get into that. But what we've got here is that those main regions recovered much more quickly than the smaller regions. So Auckland recovered in 3 years and 8 months. Canterbury, 4 years and 2 months. Then we get to Bay of Plenty, which has our fifth biggest city, Tauranga, 5 years and 6 months. Then Waikato, which has Hamilton, 6 years and 4 months. Now Wellington is at about mid of the pack. That's been a bit of an exception because it has been, or it had been, flat for about 8.5 years. And of course, we had a national government at the time, which doesn't tend to be as expansionary within Wellington. But those four major regions were all recovering much more quickly than something like Gisborne, which took 10 years and 9 months to recover based on this model. Southland, 9 years and 3 months. Manawatu, 8 years and 8 months. You see, the regional boom only happened back in 2016. The main regions recovered and had more consistent capital growth over time.
And this is something to consider if you are a long-term investor wanting to increase your portfolio. Because if you're wanting to increase your portfolio, we've all got limited cash, let's face it. So you are probably relying on that upward movement in your rental properties and your own home to be able to purchase again and again and again. And again, there's nothing wrong with, Wellington, if you'd invested over that 15-year period, because you got some pretty good growth. But in that first 8 years following the GFC, you probably felt a bit down in the dumps because you weren't able to go out and buy another property. And certainly if you were living there and invested there and had all your eggs in one basket, that was a real challenge for people. And I know because I was working with investors there at the time, because they were reading about other regions making money.
And the other thing that I'd say is we've often talked about Canterbury, for instance, being quite flat. Well, it actually hasn't been flat. It's just been growing very, very slowly, and so we've just referred to it as flat. Yes. And so it has been consistent within its capital growth. Even if we can talk about Auckland as being the largest region, it actually has been flat for the last 4 years. But if your flat patch is only 4 years in this instance, It's actually not that long compared to the West Coast, which I would argue perhaps hasn't even fully recovered, but by the model or the basis by which I ran these numbers, it would have been flat for 12 years and 6 months. You know, it's just not sustainable for a long-term investor to be waiting around for capital growth like that while outlaying for the deferred capital maintenance and potentially topping up a property if it is negatively geared when interest rates are a bit higher. So again, I just want to say, no, this wasn't data abuse. Over the long term, a lot of the regions, at least over the snapshot that we've got, that time period, did increase at the same or a similar amount to some of the larger regions like Auckland. But there are some other factors that you want to look into around consistency of capital growth and, of course, that deferred capital maintenance as well.
And that's what's really important, that you don't just look at the growth numbers. You have to look at a few more different things, and the devil is in the detail. So keep listening to the show.
Fantastic. Let's wrap it up there, but please don't forget to rate, review, and subscribe to the podcast. Really helps us get the message out to more people. And hey, if you've got a topic like Johnny had for us, give us a text. Our number is 5522. It'd be great to hear from you. Thanks for listening to the Property Academy podcast. I'm your host, Ed McKnight.
And I'm Andrew Nicol.
And we're going to be back again tomorrow with even more daily strategies, tactics, and insights to help you get the most out of the New Zealand property market. Until next time.